Welcome to the Power Hour that's focusing on Japan, and it's going to be chaired by Professor Hank Pruden from Golden Gate University. So I'll hand over to him.
Thank you very much. Delighted to have you with us here. This is a great tradition of IFTA conferences, our coverage of Japan. And today we have three outstanding speakers. They have a lot of information packed in each one of their speeches, and therefore I have a special request to make of you all. Please, no questions. No questions during or immediately after, because they'll be, say, they concentrated. If you wish to pose questions, you may do so after the panel's discussions have concluded. Now, our speakers today are Mr. Feng Han, Mr. Masaki Yamada, and Mr. Chris Grafton. Gentlemen, take it away.
Thank you. Okay, so it's really a great honor to be speaking to such a distinguished audience. I'd like to first thank the committee for inviting me, and my colleague Jeff Hockman for his recommendation and his great advice during my research. So I'm going to talk about hiking ashi. In Japanese, it means average bar or average pace. I'm going to walk you through how hiking ashi is constructed, its attributes in terms of both strengths and weaknesses, and also, more importantly, how to make it a stronger tool for us. Well, you know, Japanese have been using technical analysis for well over 200 years, and they have been very creative in technical analysis, as they are in other fields of research. And I'm sure if there were Nobel Prizes for technical analysis, there must be winners from Japan for their creation and contribution in chart tools like Ichimoku or candle chart, as shown in this slide. Hiking ashi, in contrast, as shown in the bottom part of the chart, is a less known and under-researched tool. To be honest, when Jeff approached me about half a year ago, asked me about, say, whether I would like to take the challenge of speaking about hiking ashi, I had little idea about what it is myself. And I also found out, say, later on, there were very few research resources available on the website. I contacted my friends at NITA, and I didn't get much either. But there were two very useful research, one done by Dan and one done by Xiao Wing. And I really appreciate the insights again from their research paper. So from my own research, what I found out is that hiking ashi is a very simple tool, but it's also a very powerful tool to use. So I hope by the end of my presentation, you would like to consider it and to add it into your toolbox. So let's start by taking a look at, say, how hiking ashi is constructed. Similar to candle chart, each bar in hiking ashi also consists of 4 prices: open, high, low, and close. To differentiate, let's add a letter M for modified in front of each. So we get MO, MH, ML, MC. And using the data provided in the middle part of the slide as an example, how it's calculated, starting from hiking ashi close price, which is MC, it's the average of the current periods open, high, and close, which is in this case is the average of 1, 2, 3, 4, and you get 2.5. Hiking ashi's low price, which is MO, is the minimum of 2 data points. The current period's low, which is 1, and the current period's hiking ashi open price, which we assume it is 1 as well. So we get 1 for hiking ashi's low price. Similarly, for hiking ashi high price, it's the maximum of the 2 data points. The current period high, which is 4, and the current hiking ashi open price, which is 1. So we get a high of 4 for hiking ashi's high price. Lastly, hiking ashi open price, that's where the real value of hiking ashi is to me. And I'm going to talk about it a little further in the next slide. But for now, just remember, it's the average of its previous hiking ashi open and its previous hiking ashi close. So because of the construction difference, as shown by the bottom part of the chart, the 2 chart there, on any given day, the hiking ashi chart can look quite different from its candle chart counterpart. So let's take a further look at the details of hiking ashi's open price construction. Just now I mentioned hiking ashi's open price at any time is the average of its previous hiking ashi open and its previous hiking ashi close. So by extending the calculation further back, you can see, as shown by the middle part of the slide, about more than 98% of the current Heikin RC open price is actually attributable to the price movements in the previous 6-time bar. So that, in fact, make Heikin RC very close to a six-bar time weighted average. And that's why Heikin RC got its name in Japanese, average bar or average pace. So that's the first distinct underlying component of Heikin RC. It's a time-weighted average. In addition, if we compare, say, Heikin RC's close price, which is the average of today's close and today's open, compare that close price versus Heikin RC open price, it's actually very like comparing the current closing price versus the underlying 6-time period moving average. And therefore, with Heikin RC, you also get like a trend indicator, and that's the second distinct underlying component of Heikin RC. It's an embedded trend indicator. Now let's move on to Heikin RC chart patterns. Similar to candles, you get a white hollow body if the Heikin RC close is above its open, and you get a dark filled body if its close price is below the open price. But different from candle chart, where you could have like 100 more patterns, in Heikin RC, there are only 3 basic patterns, equivalent to bullish, bearish, or neutral ones. So taking the example of the first one on the far left corner, a big white body, hollow white body with only one shadow on the top side, that's the bullish pattern. That only happens when price, the underlying price, is above the underlying 6-bar moving average. And in contrast, next to it, if you have a dark filled body, that's of bearish trend implication because that happens when the current price is below the underlying 6-bar moving average. So when you see these 2 types of candles in Heikin RC, you just need to stay with the trend. Very simple. In contrast, as shown by the bottom 2 panes of the chart on the left-hand side, when you see shadows on both sides of the body, that's the time you need to stay alert for potential trend reversals, because shadows only appear on both sides of the body when the underlying price is approaching or crossing the underlying moving average. So the things to remember here, so far, it's pretty straightforward. In terms of Heikin RC's nature, 2 underlying components, it's open price, it's actually a time-weighted average, and Heikin RC, because of that, becomes an embedded trend indicator. And there are only 3 basic chart patterns equivalent to bullish, bearish, or neutral, depending on the color of the body and the number of shadows around the body. Okay, so with that background knowledge in mind, let's take a look at what strengths Heikin RC offers and what weaknesses we should be aware of. There are 4 major advantages of using Heikin RC. First and foremost, lies is small. This is a slide of S&P 500 quarterly prices over the past 20 years, with candle chart at the top and Heikin RC chart at the bottom. You can see in most of the periods, as highlighted by the rectangles, trend and trend reversals become very easy to identify by just following the color changes. Why? Heikin RC changes color while the underlying price crosses above or below the underlying 6-time bar moving average. You may also notice that in Heikin RC chart, once it changes the color, it tends to sustain for a much longer period than the ordinary candle chart does. And that is because, as I just mentioned, Heikin RC chart is actually an embedded trend indicator. It does not give you as many signals as the ordinary candle chart does. Now, in addition to not only trend and trend reversals become much easier to identify by just following the color changes, the strength of the trend is also becoming very obvious with Heikin RC chart by just comparing the size of the candle body. And why is that? The bigger the body, the more powerful the current price is away from the underlying moving average. Now let's take a look at this slide. This is a slide of the ordinary candle chart with moving average at the top and Heikin RC chart at the bottom. So when you see from the top chart, when price is approaching or crossing the underlying moving average, Heikin RC chart starts displaying shadows on both sides of its body. So without any moving average, by just looking at the shadows, you can have a gauge if the underlying trend it's becoming weakened. So hiking RC chart also works as a warning signal upon emergence of shadows on both sides. Now, on top of working as a trend detector, hiking RC can work smartly as a momentum detector. What we need to do is just tweak a little bit by taking the ratio of the hiking RC's close price versus its open price, which is the right line we get in the bottom part of the chart. And if you think about it, it's very similar to the momentum oscillator of, say, percentage deviation from the underlying moving average. So with that, let's take a look at the case of Nikkei over the past 20 years. The market tends to get overbought at around 1.1. That's a hiking RC delta. And it gets oversold when the hiking RC delta, which is the right line, again, drops to about 0.9 level. So that sounds great, right? Can this be back-tested, and how does it work on a back-testing basis? So here I did a mechanical backtesting by just following the color change strategy. So let's go long when we see the white body, and let's go close long and go short when we see it change the color to the dark body. So compared with the about 25% decline of Nikkei over the past 20 years, as shown by the blue lines, color change strategy alone can more than double your investment. However, you can also notice from the rectangle period, drawdowns can also be pretty bad. And why is that? That brought us to the two weak aspects of hiking RC. One, because hiking RC's open price is a time-weighted average, and as moving averages always are, they tend to give you too many noises, especially during range-bound markets, as highlighted in the yellow rectangle period there. Also, as moving averages always are, hiking RC may be late at major turning points, as highlighted by the yellow arrows in this slide. So now we have a challenge. How can we avoid its two weaknesses, and how to make it a stronger tool? Well, we all know in order to reduce the number of noises, we can smooth further, and to cut down, to avoid delays, we may seek another momentum oscillator for help. So to reduce the number of noises, first of all, I tried 3 different types of methodologies. As time does not allow me to go over all of them, I'll just focus on the one that I really like, which is on the far right. So here, instead of just comparing hiking RC's close price versus open price, what I did is compare the current price, which is the blue line, with the average of 2 moving average, which one being the price 6-month moving average, and the other being a time-weighted average of hiking RC's open price itself. So we use the crossovers as indicated by the circles as buy and sell signals instead. And the result, as shown in the orange equity line in this slide, is a return of about 370%. And that's more than 3 times than the hiking RC color change strategy can offer us. And why is that? By further smoothing, the number of noises are greatly reduced, making hiking RC even a better tool in a trending market. Still, as indicated by the rectangle, I hope it could be bigger, and also the lines, you see during the range market or at major market turning points, the performance still remains lackluster. And this is because the problem relating to delays remains yet to be addressed. Oscillators come to rescue to reduce the number of delays. And here, I tried 2 types of oscillators, both derived from hiking RC. One being hiking RC delta, which I just introduced, which is the ratio of hiking RC close price versus its open price. As you can see from this slide, the divergence is both negative at the market top, as indicated by the right arrows, and also the green arrows, which is the positive divergences at major market bottom, can help us avoid a lot of delays, if not all. However, the interpretation of or identification of these divergences requires subjective interpretation. I did not include it here for mechanical backtesting purpose. What I did instead is to smooth further of hiking RC delta itself, one short-term moving average, one longer-term moving average. And then use the crossover of those two smooths, hiking RC delta, to work as a momentum indicator, because theoretically, that should work better than hiking RC delta itself as a gauge of the acceleration or deceleration of the underlying momentum. So how did it work? Well, as indicated by the purple active line, this momentum-based strategy performed pretty well as well. And the return is about 330%, quite similar to the return from the further smoothing approach. However, if we overlap those two active lines into one chart, as shown in the top left corner, you can see the two strategies arrived at this return via very different paths. And the underlying buy and sell signals, as indicated by the orange bars and the purple bars, seem to have a little correlation as well. And I did a check. It shows me that the correlation between the two model is just a little bit of 0.3. And that low correlation opens the door for further enhancement. So the question is, how could we do it? Well, I think we can put things into context first. As you can recall, further smoothing works best in the trending market, while momentum-based approach can greatly enhance your performance during non-trending market. The only tool that we need is one that can tell us whether the market is trending or not, right? And DMI, the Directional Market Movement Index, seems worked perfect for that purpose. So here, let's add the ADX into the chart, and that's showing in the middle part of the chart. And let's follow the trend strategy if the ADX is above 20 or if market is trending. And let's turn to momentum-based approach if market is not trending when the ADX drops below 20. And now we got a different set of buy and signals as shown by the green bars in the bottom part of the chart. How about the return? The green line is the active line based on this dynamic switching model. And that's well over 900%, almost tripling again from the previous two strategies implemented separately. And I think that's a great example of 1 + 1 could be much bigger than 2 in technical analysis as well. And it also shows that picking the right tool at the right timing is really a critical part of technical analysis, which I think some of the research fails to take into consideration when they backtest, say, the efficacy of technical indicators. And looking at the range market as represented by the two rectangles, you can see this dynamic switching model also achieved positive return in those respective periods as well. So that's another encouraging improvement. So I'd like to stop here by wrapping up with a few takeaways. First, on hiking RC, just remember 2 underlying components and 3 basic patterns. The 2 underlying components is hiking RC open price is a time-weighted average. And because of that, hiking RC becomes an embedded trend indicator. There are 3 basic trend, hiking RC patterns equivalent to bullish, bearish, and neutral, just depending on the color of the body and the number of the shadows around the body. And in terms of its attributes, 4 strengths, 2 weaknesses. And the 4 strengths are trend reversal, strength of the trend, and potential trend weakening can all be gauged with hiking RC, all its delta. Or put it in one word, hiking RC makes trend following strategy much easier. And the 2 weaknesses are delays and noises that we should be aware of when using. And to overcome those weaknesses, we can introduce a momentum oscillator, we can smooth further, and if we put things into contact by combining the 2 models in a dynamic and optimal way, the return can be greatly enhanced further. So with that, I would like to stop here, and I'd really like to thank the committee for having me involved in popularizing this new tool, and I hope you find it useful, and hope you would like to try it out in the future. So very lastly, since I still have like 1 minute left, just going through like the 3 appendix chart, because Heiking RC is actually an embedded trend indicator, and because Heiking RC delta is a momentum indicator, so you can use that not only for Japanese market, as I just went through, it should be applicable to most of the active asset classes, as I did here with S&P 500 over the past 20 years, with gold over the past 20 years as well, and the Forex market, the dollar-yen market as well. Thank you.
I will speak the focus of the Japanese stock market using a new technical indicator, the BPB ratio. I, by myself, created the BPB ratio the last year, so you may need a detailed description of it. I will speak about the description of the BPB ratio first, and I will speak the forecast with that indicator next. BPB ratio is a technical indicator that combines two statistics, Viper variation and realized volatility. This slide shows also the definitions of Viper variation and realized volatility. After calculating the logarithmic rate of change of a stock price, these values are calculated respectively from n successive sequence of the logarithmic rate of change. Let's consider the case that the stock prices are repeatedly fall or rise in the same proportion. This is a very case that the stock prices move in the binomial tree. If the stock prices move in the binomial tree, the absolute values of the rate of change are always constant, regardless of n and I. Hence, the BPB ratio will be a constant value, pi divided by 2. If a stock price deviates from the binomial tree, the BPB ratio decreases. Let's check it by a simple example. Let's assume that n is 5, and let's consider the case that the absolute values of rate of change were successively 10%, and different absolute value of 20% becomes at the present. By a rate of change deviating from the binomial tree, the BPB ratio decreases by about 20%. As inferred from this example, the BPB ratio is the index to quantify the distance between the binomial tree and the movement of stock price. Next, I will explain why I talked about the binomial tree. I would like to quote the paper of Stein and Fong, Journal of Finance in 1999. In the paper, the market participants are classified into two groups, that are news watcher and momentum trader. When news watcher is given cash flow information, they buy or sell a stock regardless of the price level if they receive the good news or the bad news respectively. Momentum trader buy or sell the stock, seeing the movement of stock prices without getting cash flow information. Moreover, momentum trader is supposed to close his position after a predetermined time had elapsed. First, let's consider a market consisting only of news watcher. Stock prices will start rising when good news comes in the market at the time A. While the good news spreads to the market, stock price rise. After the news goes around the market participants at the time B, stock prices will be fixed at a constant. This level of stock prices is an informational efficient price, a fair value. When momentum trader joined here, then the movement of stock price looks like as this slide in their model. When buying of news watcher disappears at the time B, stock prices will fall in order to balance selling of momentum trader. After the time B, all shares will be traded among momentum trader, and share price will fluctuate around the fair value. I thought this movement, as shown in the slide, might be happen in reality. So I investigated if the movement of actual stock prices consists of two phases. The former phase from the time A to the time B, that is on the binomial tree, and the latter phase after the time B, that is a deviation from the binomial tree. The relationship between the BPB ratio and the such movement of stock prices is supposed to be like the two graphs shown in the slide. If you set the threshold H properly, you will find the time when stock price enters the trend at the time point C in the slide. The direction of the trend is forecasted to be a sign of the rate of change of the most recent of the time point C. I calculate the BPB ratio of Nikkei 225 with n set to 10. There found 3,614 BPB ratios in the period from January 2000 to the most recent day. And there also found 363 entry points, like at the time point C, when the threshold is set 0.933881, that is the median of the BPB ratios from January 2000 to December 2013. The slide shows the correlation between the sign of the last rate of returns at the entry point and the subsequent rate of return from the entry point away from each working day. These correlations are significant at 98% confidence level. The movement of stock prices that we assumed at the above seems to be realized all right. The slide shows the result of the backtest. The backtest to Nikkei 225 simulated the trading rule from January 2000 to the most recent day. The trading rule is, if BPB ratio exceeds the threshold, then the position starts, and the position is closed at a constant number of days from the entry. The performance of the trading rule was good, as the statistics in the previous slide indicated. Now, I can go on to the talk of the forecast. It may be a bold idea, but I take the position that the existence or the absence of newswatcher in the market can be determined by the BPB ratio. Newswatcher is participating in the market if the BPB ratio is greater than the threshold, while newswatcher is absent in the market if the BPB ratio is smaller than the threshold. I color the stock price red when newswatcher is absent and black when they exist. BPB ratio was smoothed using a Kalman filter since it is very volatile. The threshold was set at above 0.933366. That is the median of the filtered BPB ratios from January 2002 to December 2013. This slide shows the price history of Nikkei 225 from January 2005 to December 2007. Next, this slide shows the price history from January 2012 to the most recent day. I calculate the accumulation of the change of stock price only of those in black. This slide shows the accumulated price in sequence. Newswatcher buys or sells when he receives the news. This accumulated price can be thought to be consisted by the information that flowed into the market. Though stock prices can overreact if momentum trader joins the market, the overreaction part is assumed to be offset by the vertical movement of the stock prices. Hence, the accumulated price may reflect the information efficiently. That is, the accumulated price is an informational efficient price, the fair value. The difference between the accumulated price and the actual price is about 4,000 yen at the present. I expect both will converge each other in future. The rise of stock prices inlet is necessary to fill the current gap. Therefore, I think that there exists rising potential of the Japanese stock market. In the slide, there were at least 4 points in the past when the gap reduced: 2006, 2007, 2009, 2010, and there is a gap reduction seems to be in progress. Since the current gap reduction period has passed longer than these 4 points, I think the market is now under the new valuation. I forecast the Japanese stock market will repeat the mixed movement of the binomial tree represented by black and the sharp rising by red until the gap is eliminated. Thank you very much for your attention.
Okay. Hello, I'm Chris Grafton. I'm going to talk to you for the next 15 minutes about the basics of cycle analysis, and the methodology I use is that of J.M. Hurst. So Hurst was an aerospace engineer working back in the 60s and the 70s in the US, and he developed a fully integrated system of market analysis based upon cycles. Again, it's a big subject. We're not going to have time to cover all of the interesting tools and techniques, but at the end of it, you should have an idea of the core principles of cyclicality, and we're going to apply that to a couple of Japanese-related charts. Okay, so just to start with, to define a cycle is the recurring fluctuation of an observed variable around a zero line. Okay, so in the market, the variable is price, and the center line is a trend axis, be that up, sideways, or down. Bear in mind that the trend axis is just the straightened out portion of longer cycles. Okay? The medium through which market cycles propagate is, of course, the emotion of market participants, the mood of the crowd. Okay, so just let's quickly get our bearings, look at some of the basic components. Period is the time duration between two adjacent troughs in the same cycle. The power or the amplitude of the cycle is the vertical interval from the trough to the peak, and phase is where we're at any given time in the cycle. So topping, bottoming, hard up, hard down, these are descriptions of phase. Also, phase can describe the lead and lag time between two different data series. And we use this into market analysis. Speed varies over the lifespan of the cycle. So at the top and the bottom, the cycle is moving most slowly. This is where we use our momentum indicators to look for divergence, bullish reversals, and all that. And between the trough and the peak, halfway between, the cycle is moving at its highest rate of change. Okay? Points B and D. So Elliotticians refer to this as the point of recognition, the wave 3 of 3 of 3, where the market stops looking down in fear and starts looking up in hope. Okay, so onto the core principles. Proportionality. Broadly speaking, period is proportional to amplitude. So it makes sense that an 18-month cycle will move prices further than a 20-week cycle, and a 20-week cycle will displace prices more than a 20-day cycle. The reason this is important is because once we've identified the magnitude of a particular cycle, we can thereafter make an assessment of the likely move out. Okay, nominality. Rather than there being an infinite number of cycles in the market at any given time, what we find in the data set is a family of cycles, from very long to very short. And Hurst called this the nominal model. So when we start cycle analysis, we start on the weekly chart. We look for manifestation of the 80-week cycle, which is the 18-month key cycle, as measured, in fact, by the 200-day moving average, the 40-week cycle, and the 20-week cycle. Moving our analysis onto the daily chart next, we look for manifestations of the 80-day, the 40-day, and the 20-day cycle. Now, bear in mind that cycles run in calendar time, and most of your software will be set up for trading days, so we need to make a conversion. 80-day is 55 days, 55 trading days. And so, you're familiar with the popular 55-day moving average. 40 days is 28 trading days, very close to the standard setting for MACD, 26 days. And 20 days, of course, is 14 days, the default setting for RSI, stochastics, DMI, and the like. So even if you're not a cycle analyst, indirectly, you're looking at cycles through some of the indicators you may use in your day-to-day work. Okay, so you may have noticed there was a relationship between the nominal values, the long-term moving averages, and that relationship is contained within the principle of harmonicity. So the harmonic factor in cycles is 2, except sometimes it's 3, and we're going to talk about that when we look at some Japanese equity charts in a minute. What that means is if you found a 20-week cycle in the data, you know that it's either the first half or the second half of a 40-week cycle. Subdividing it down, you know that it consists of 2 10-week cycles, manifestations of those cycles. Okay. Synchronicity, cycle troughs tend to synchronize in equity markets. So what that means is that once you've found an 18-month cycle, you know that it is the same time location as the 40-week, the 20-week, the 80-day, and so on. But on the other hand, peaks tend to top out successively. So there's a qualitative difference between the two. Okay, so they're the core principles. The final one is the principle of summation. That says that cycles combine by simple addition. So when you're looking at a price chart, similar to the one in the top left there, what you're actually looking at is a composite cycle. Okay, it's a combination of a multiplicity of interacting, harmonically related cycles that come together to form the whole. And the job of the cycle analyst is to deconstruct that, to resolve that down into its component parts, and, if you like, create a framework of probability, a roadmap, so that you can make an assessment of where prices are, conduct a phasing analysis, and make an assessment of where prices are likely to go, and what capital risk is likely to be. Okay, so I cover the Japanese market, so we're going to look at some Japanese stuff. I'm pretty much just going to freestyle here. I wish I could show you more charts and go into the real nitty-gritty of the tools and techniques, but there isn't time. So we're just going to have a quick snapshot of how cycle analyst might go about his trade. This is a weekly log chart of the yen-dollar cross. As you know, it's been kind of key in recent times in the Japanese market. So the first thing we do, we start a cycle analysis on the weekly chart, and what we do immediately is to look for the dominant fluctuation, just by eye, and that typically is the 80-week cycle, the 18-month cycle. Okay, so the medium-size semicircles I've drawn at the bottom represent the 18-month cycle, and you can see that the harmonic subdivisions of the 40-week cycle within. I've highlighted the 40-week cycle lows with little purple diamonds as well. Now notice in the phasing analysis here that the 80-week cycle is actually running a little long. That's to be expected. There is going to be some variation around these long-term averages, some ebb and flow around the mean. And here it's running at 94 weeks. The overarching cycle that I've drawn in is the 54-month cycle. We haven't talked about this before, but this is where the harmonic relationship changes to 3. So there are 3 18-month cycles in the 54-month. This broadly equates to the business cycle. The only other time we see this is with the 18-year cycle. There are 3 18-year cycles in the 54-year Kondratiev wave, which I'm sure you're familiar with. So let's go to the last date. It's this week, and see what the general phasing analysis would tell us and a general status of the combined cycles. You can see that the 54-month cycle is topping, and the 18-month cycle is topping to down. So you can see the phase there, 152 weeks along, 61 weeks along respectively, and there's the status. So the long-term cycles, the environment, if you think of it as flow, the environment is quite benign. The 20-week cycle, the little one right at the bottom, is topping. The only cycle that's actually driving prices up at the moment is the rising 40-week cycle. So the analysis here suggests that we are looking for an 18-month cycle high, and the 40-week cycle is what's going to take us there. Okay, so moving on to March 2015, you can see that the landscape there is slightly different. Here, the 54-month cycle is actually topping to down, the 18-month cycle is down, the 41-week cycle is down, and the 20-week cycle is topping. So this analysis suggests that we're coming into an 18-month cycle high, and thereafter the price path will be down. The final push-up into March 2015, if this analysis is correct, will be a counter-trend move of the 20-week cycle. I think it will mark the end of the so-called Abenomics rally. So moving on, once we've done the weekly chart, we switch down to the daily chart. And, right, okay, so we've got the, as you can see, the 40, this is back from July 2014. The trajectory of the 40-week cycle is shown. You can see that's the tailwind for the 20-week cycle, which is responsible for that fast move up from July. So what I think is happening now is that we are seeing, this is slightly out of date, this chart, we are seeing a move down into the first 10-week cycle low, the harmonic subdivision of the 20-week cycle. When this bottoms, maybe sub 107, 106.5, something like that, you should see the 10-week cycle will start rising into a benign 20-week cycle. The 40-week is still a tailwind, and we're heading into the anticipated 18-month cycle peak. Okay, there's a bunch of other tools we could use, but that's the broad brushstrokes. Okay, last chart. This is the Topics Transportation Equipment Index, which is autos, Nissan, Toyota, MIT Motors, and all the rest of them. So you can see the 54-month cycle. It starts pretty much at the same time as for the yen. But notice in the phasing analysis that the 18-month cycle has actually been truncated. We're down to 82 weeks, and it's a lot closer to the actual nominal model, Hurst nominal model. There's good theoretical reasons why I've chosen the June as the 18-month cycle low there, rather than August for the yen. And you see, if we go to the last date now, drop a vertical line down through the cycles with their various phases, you can see actually where the cycle is, the composite cycle is further advanced. The 54-month cycle is topping to down. The 18-month is down, the 40-week is down, and all we've got really holding things up is the smaller, the shorter 20-week cycle. So the analysis here suggests that obviously the environment is much less benign. The TP Tran is leading the yen, if this analysis is correct, and it makes sense. The automakers are heavily geared into the yen. And what we're seeing now is potentially a move up into the 18-month cycle high, where thereafter the price path should be down as the 54-month cycle rolls over. So that's pretty much it from me. I wish I could show you more. Cycle analysis is best employed with a full suite of tools and in conjunction with other methods, especially Elliott wave. Point and figure works very well with it. DeMark for your momentum, for your trend exhaustion signals, and obviously good use of momentum indicators to pick up the different speeds. The good thing about cycle analysis is it gives you, in a way, it allows you to pull back the curtain on the market and take a look at the actual structure to see what's driving prices. Okay, that's it. Thanks very much indeed.
We've got time for some questions. Any questions from the audience at the moment? Not just about their presentations, but these are experts on Japan. So if you've got any questions about the Japanese market. Deborah's got one.
I wonder if each of the panelists could tell us where they see the Nikkei in 3 months and 6 months.
Shall I go first?
Shall I start?
Yeah, go ahead.
Can I do the topics instead? I look, there's a more representative index. It's market cap weighted. Okay, so the interesting thing, this is non-cycle analysis. If you draw a trend line down from the 1989 top on a log chart, a monthly chart, down through the 2007 top, okay, it tops out, our prices reach that trend line around about 1500, sort of around about where my yen analysis was. And the interesting thing about that point in time, after this very, very fast rally, which will have completed like an impulsive move up by that time, is that the equivalent level in the Nikkei You could remind me of the price that hit in May, I've forgotten. But it hit that level in May 2013. And you know what happened in May 2013? The market moved down very sharply. So I believe that 1500 is a natural target for topics, and I think the market will react when it hits that long-term downtrend channel return line. I think we're going to see a significant reaction. I personally believe that will mark the end of the Abenomics rally.
大丈夫ですか？いいですか？じゃあ僕はありますね。すいません。Okay, from my side, I think back in March, I made a call like we're going to see a spring rally. And then when I had the internal indicator review back in July, I made the forecast say topic is going to at least try maybe around 1340 something. But right before this trip, at the end of September, when I make the market update, I said, say, pullbacks first before trending higher. So that's my current view on the Japanese market. Long term, there is still hope. Actually, it's not just hope. I think there is good reason to expect further upside, both technically and also from fundamental reason perspective. But near term, although you see the topics on Nikkei has just set consolidation new high, but I have a lot of data, but what the data shows me, like the recent rally is really a low quality, as my colleague Jack put it. And for me, it's like a very low convincing rally because there are several ingredients lacking for a strong rally to carry on. One being the volume. So I don't have the chart here, but if you can recall, in Japan, there is another quite similar range market period that's back in 2004 and 2005. That's before the I think Koizumi rally. So we have the similar range setup. We have the similar range breakout. But what's different this time, we don't have the similar volume pickup upon the recent setting new high. The other thing is, if you look at topics in dollar term, that hasn't break out either. Actually, it has been keep falling down from the recent high set back in summer. And the reason for that is because the recent yen depreciation has been outpacing the gain in the equity market. And that's really important because for Japanese market, I think 60% or more of the trading value of the trading is actually done by the overseas investors. So for them, there's not a hurdle has not been broken yet either. And another kind of say low convincing rally is from the investors' appetite. When you see a strong rally, you tend to see in Japanese market, brokers tend to power high of the market, as it happened after the 2005 market breakout. But for the whole year, whether the market goes up or whether it pulls back, so far brokers' relative keeps deteriorating. So that's another warning sign. On top of, say, some of the technical negative divergence, you don't have the momentum confirming the index higher high. You also have the trend approaching the kind of complicity level. So near term, back to your question, I'm very concerned, and as it's happening right now. But long term, I do hope, I still expect further upside. And I think one of the drivers so far for the past 12 months is the yen. If you look at the past 12 months through the end of September, market was up in yen term about 11% something, but in dollar term it was flattish. That tells you everything. This is a currency debased driven rally. And going forward, I'm in the cap expecting further yen depreciation, and I think that's going to be the driver for further topics rally going forward, probably only in yen terms. Thank you.
Are there any other questions? I've got one. Trying to link what the previous topic was about black swans. I know it's very hard because you can't normally identify a black swan, but looking at Japan and what's happening there, if you had to pick a potential black swan in Japan, what would it be and why?
Well, black swanについて何か日本にあったら何かあると思いますか？
I come from financial engineering, so except this presentation, I spent no time to forecast. So I know black swan, but in this my presentation, the Japanese market is very strong because I showed the expectation level and the actual level is the gap is about 4,000 yen. This is the result of my analysis. So I think in Japanese market, black swan is seemingly it is difficult to think about the coming black swan in Japanese stock market. This is my feeling.
Would you mind? That's mine too. Okay. So if we think about, say, what has been the black swans in Japan, I think you can attribute to both external events and also kind of domestic events. And we have already, like, say, two biggest earthquakes in the past 20 years. So that's kind of something you kind of forecast as the previous presenter termed it, black swan event. It's something, an event that you cannot forecast. And the other is really from the external world, whether it's global financial crisis or the September 11 terrorism. But one thing going forward, say, apart from those kind of similar events, which I surely hope would not repeat going forward, is the potential Japanese debt problem. You know, Japan has the biggest, say, debt ratio to GDP, and the economics so far works in a way, say, to, it's like a push or keep the interest rate in a very low level, but can they, say, be successful in doing so going forward? And if not, I think that could be a potential catalyst for selling off the Japanese bond market, which is surely not good for the equity market as well.
Chris?
I agree. I think it's, I think a black swan event, apart, from anything internal, like an internal collapse of Abenomics for whatever reason, or an outside event, would be, it's largely macro-led as well. And I think we need to be looking outside, but right off the bat, apart from anything obvious, major disasters or something, I don't know. The sudden end of the Fed supporting the Fed bid would be my thing, but I can't forecast what when that would possibly end. But the end of the Fed bid, that will end. That would end the markets. Full stop, wouldn't it?
Are there any other questions? Well, with that, we might draw to a close. And I'd just like to say, being Japanese, arigatou gozaimasu, and a little gift.